Hey traders, this is Blake Morrow with Trader Summit, and with me today, it's Friday and I've got Jim Welsh from Macro Tides. It's so good to see you, Jim. And it's always nice to actually talk to you and get caught up with the week. And this has been a whirlwind week. We've had central bank it was like a bonanza and or extravaganza. And I guess we could start there. So how you been?
Sure.
How did you interpret the FOMC this week?
Well, going into it, Blake, in this Monday past weekly technical review, and then I always put out the macro tides the first day of the month, so that went out on Tuesday. My take was that Powell was going to push back pretty hard on the idea that the Fed would be downshifting in December. Not that it may or may not happen, but I just don't think the Fed is ready to have the street already incorporating that into what their expectations are. I think he wants the optionality, and he did push back pretty hard. And the other thing he did, Blake, which was kind of somewhat significant, is he said, the dots that we gave in September, which called for a peak at 4.6 in the funds rate, if we did it today, it probably would be higher. And the other factor being, we're going to hold it at a high level for a long time. And that is the thing that the street still hasn't, I think, acknowledged and accepted, because the curve of the funds rate now is at 5, but they're still looking for the funds rate to start coming down by middle of next year, which doesn't jive with what the Powell and everybody else has been saying on the FOMC.
But what do you think was the statement in your view that turned the market when it did? I mean, because the market interpreted as somewhat dovish, but then and it kind of played it as such, or maybe it's just not as hawkish as people expected. But during the speech, he said something, in my view, and I want to get your opinion though. What was it that actually turned the market?
I think it was a combination of things, but also when he, again said it's way too early to be thinking about a pause. Remember back in June of 2021, it was, we're not even thinking about raising rates. And to me, that was like the counterpoint to, it's way too early to even begin thinking about a pause.
Yeah.
And, again, it was a culmination of a number of things that he said. Like I said, saying that the dot plot would be would be higher than 4.6, like, whoa. And again, the street still hasn't fully, I think, realized that they're serious about getting up to that restrictive level. And his point was, it really doesn't matter so much of how we get there, but understanding that once we get there, it's going to stay there. And so I think it was a combination of comments that he made, Blake, that just sunk in, because the market kind of to fade, and then it started to fade a little bit more, and then it faded a little bit more, and then it was like every man for himself. I'm getting out.
Well, I guess what we should do is we should pull up your first screen regarding Powell and sorry, I'm just trying to get situated here. So let me go ahead and pull that up and let's see what your notes are saying.
Yeah. Okay. My notes are basically saying what I just said. And that is, that he'll push back. And what I included in Monday's letter and the monthly letter was these two charts showing the core PCE, which is theoretically the Fed's favorite thing. Yeah, it peaked in March at 5.3, pulled back to 4.7 in July, and then it's upticked the last 2 months to 5.1. And then, the core CPI actually made a new high for the cycle at 6.6. And then, as you and I have discussed, and Powell has gone on ad nauseum, that looking at the extremely tight labor market, and one of his favorite indicators that he has referenced repeatedly is the ratio of job openings to the number of people who are unemployed. So it dropped from over 11 to 10 million. They revised that number up. And then the most recent number would have been for September. It ticked up to 10.7 million. So the job ratio now is 1.9. And at a minimum, it needs to get back to where it was in 2018, which was about 1.2. And I think it really needs to get below that. So from Powell's perspective, and the other members of the FOMC, they don't have any real evidence saying that inflation's peaked, and definitely no evidence that the labor market is easing up. And, so to me, those are the facts. And I just felt that Powell was going to kind of say, hey, look at the data. We're data dependent. Look at the data. And the data doesn't tell us that it's time to do anything other than what we've been doing. So,
Well, so
yeah.
how are you going to relate? How are you going to translate that into equities? Because, at first equities came off and I think the market was thinking, oh, we're going to get some, severe risk off here. We're going to just see some selling again. But what do you make of it? Because
Yeah.
here we are, over the last couple of days and we've recovered a
Yep.
bit.
Okay. So on Monday, my take was, hey, lightening up near 3,900 makes sense. The market was very kind. It popped on the opening to 39.12, and then you can see the spike and then subsequent reversal lower. The 50% retracement of the rally from 34.92 to 39.12 is 36.98. And lo and behold, what was the exact low? 36.98. So again, it underscores machines are at work here, utilizing some of this Fibonacci stuff, right? So we're at a tricky point. My assumption was that we'd have this pullback and then rebound and make a higher high. That the rally from 34.92 to 39.12 was wave A, a pullback for B, and then an equal rally would be 400 points, get you up towards the 4,100 level. The key in my mind for that to be played out, Blake, is holding 36.98. If you take that out, there's a risk that we're going to continue to tumble. So to me, that has to be the stop loss point on the assumption that we're going to see some positive. Now, the election's coming next week. And at the conference, one of the points I made wasn't political. It was just everything's focused on the Fed. So if the Republicans take the House, we're not going to see any more spending bills show up in the next year or so from Congress. Well, if you have less demand coming out of federal fiscal policy, that helps the Fed. And if they take both the House and Senate, which really may not be known until December 6th, because Georgia is one state where you have to have 50% of the vote, so, but just getting the House kind of kneecaps the idea of more spending, which then would be perceived as, okay, we don't have to worry about more spending, making the Fed's job more difficult, and the market will respond favorably. The other piece that news that you referenced is the CPI that comes out next Thursday. I think there's a really good chance it's going to downtick and have a 7 handle. So in September, the last month it went from 8.3 to 8.2, in part because the actual month over month was a plus 0.3. The takeaway value from September of 2021 was 0.4. That's why it downticked. Well, the takeaway value from October of 2021 is 87 basis points. So even if the CPI for the month of October goes from 0.3 in September to 0.4, you're going to subtract 40 basis points or more from the headline. So to me, there's a real good chance it could downtick from 8.2 to 7.8.
Wow.
And if that proves correct, that could easily revive the idea, oh, no, that gives the Fed room to only go 50 in December. Now, we still have the other issue of, wait a second, they're still going to go higher. They're still going to hang on to it. But these days, those kinds of news and reactions to it can be quick and fast. Goldman Sachs calculated that in the third quarter, 40% of the volume was dictated by option trading. And as we know, more and more of the option trading is like for less than a week.
Yeah.
So that has nothing to do with the economy, really, longer term. It has a lot to do with positioning in any given day. So anyway, to me, there's the potential 2 news items that can help the market have that C wave rally up towards 4,100, predicated that we hold 36.98.
All right. Well, let's see how you view the bond market right now.
Right. As you know, I recommended TLT third, going in 33%, 33.33. The average price is 103.07. Kind of got run over on that. Bonds were down 12 weeks in a row. I brought up the idea that I think there are central banks selling bonds. So here's what's happened is the dollar strength means other currencies are weaker. So when other countries buy food and oil, they're paying whatever the going rate is, plus whatever the percentage of their decline in their currency. So the strong dollar in this environment has been exporting inflation. Other central banks have been hiking rates to kind of support their currency and because of the inflation. And my suspect was that it had reached a point where central banks were actually selling treasury bonds, which they hold as part of their foreign currency reserves. And then like a week later, this chart showed up showing that, it's been massive, that you've had the highest percentage ever of central banks selling foreign and so bringing down their foreign currency reserves. And with the dollar being the reserve currency, Bank of Japan, England, the euro, obviously a lot of EM countries, the dollar is going to be in treasury bonds because they have it in dollars. They're going to park it somewhere. So to me, some of the forced selling that seemed to be driving bonds relentlessly lower was due in part to this. If the dollar tops out, that'll relieve that pressure. I think we are going to see a dollar top and reversal lower in coming months as the Fed does move toward smaller rate increases and gets closer to the terminal rate. The TLT, right now there's an island reversal. We had a gap down, gap up. I can't remember if it's 93 and change. I should have that there, but I don't. We had a pop from 91.85 to 97.90. It looks like 5 waves to me. ABC down to the lows today. So it's key that the TLT and treasury yields hold about where they are right now when we're talking on Friday morning about midday, because there's still the chance based on the pattern you could see treasury yields go up to another high. And it's certainly conceivable given, all of a sudden we're going to go to 5% funds rate, that you could see one more lower low. But I took the position because I think as we get into the first quarter, the economy is definitely going to show more signs of slowing, and we're going to be at that place where the Fed will have downshifted the magnitude of rate increases. And I think the Fed statements coming out in the next week or two are going to talk more and more about, we're getting to that point in time where 75 basis point increases aren't appropriate. And that's why that October 21st article was planted. They were in the blackout period. No one could kind of push against what was happening in the treasury market with bond yields. They had the Wall Street Journal article say, well, they're going to be thinking about talking the funds rate at the December meeting and not going 75 basis points. Now they can talk. And already today we had a couple of people say, yep, at some point in time, scaling back. Now, one of them also said, I could see the funds rate at 5. So that's going to be the duality we have to deal with, kind of the schizophrenia. On one hand, we got to keep the same messaging, going to 5, but, we're going to scale it back. I think they need the cover of CPI inflation coming down to give them some breathing room. Until then, they don't want to risk the credibility, I think, of, opening the door to a little less tightening. All right, gold.
Yeah, gold. Let's. I mean, that's got to mean it's got to be positive for gold here, right?
In the short term, the last few weeks, it's been, we talked about this pattern. Excuse me. So that the rally from 16.16 to 17.28, I have it marked A. The pullback to 16.17, and yesterday was 16.18, I think. I mean, that is wave B. And then today's pop should be the beginning of a wave C, which is what I've been expecting, above 1728 towards 1760-ish. That is either going to be the beginning of a much bigger move, or it's an ABC up, Blake, to complete wave 4. So from the high in March of last year, you got 1 down, 2 up, then a 1, 2, 3, 4, 5 for wave 3. And we're either in 4 or I still think there's a shot that you could see the gold drop below 1600 or definitely below 1616. But in the near term, my take was we're going to get this bounce first and we'll see what happens.
Okay.
There's no, and
well, if we get that balance and you get this this top in the dollar that you're expecting, it should all work together, right?
It should work together. Now, here's the pattern in the dollar. is starting to take the shape of what would be a descending triangle. So from the decline from under the number 3, that's A, B, C up to a slightly higher, it's a lower high for B. The sharp drop down that we saw a week ago for C, the 3-wave up rally to the high yesterday is D, and this is wave E. Again, I think closing below 109.20 would probably negate the potential for the triangle. The other count is we're doing a 1-2-1-2, and the dollar's going to get hit pretty hard.
Well, let's I know a lot of traders are, especially if they're trading gold or, and I know a lot of people are trying to call a top in the dollar, and maybe that'll be the case because quite surprisingly, after this week's price action, the dollar is, ending the week a lot weaker. So let's I guess we'll see how it plays out. Now, next week, it's going to be an important week with inflation. How are you going to keep your traders that are part of the Macro Tides community up to speed?
Well, I've covered it Macro Tides on every Monday.
Yeah, there you go.
This Friday,
Yeah, I know. I was trying to throw you a real easy one.
You threw me a softball and it hit me in the forehead. No, the weekly technical review is, I think, when you get into periods of higher volatility, you need something more frequently, and I can give parameters in the weekly technical review on all these different markets in terms of this is a key level. Otherwise, this is the likelihood of this happening, but I'm wrong if this happens. And I think that's indispensable for anybody who's trying to managing risk. So macrotides.com.
All right.
An email to Jim Welsh Macro at Gmail.
And guys and gals, if you like what Jim does here every week, make sure you give him a thumbs up. Reach out to Jim. He's like that buddy that everybody wishes they have. So you got one right here. Jim, thanks.
Until they get to know him, and then it's another story.
It's based on what your wife told me. Yeah, it's probably a little true. I'm just kidding. Jim, thanks
after 43 years, if anybody knows, that's how you.
Thanks for spending your time with us. We do appreciate it. Make sure you subscribe to the channel so you don't miss any of this exclusive content with Jim Welsh from Macro Tides. Jim, have a great weekend.
You do the same, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.